Ever feel like you need a clearer lens, to see through all the complexity surrounding the big tech companies and really get what makes them tick? Well, today, we're going to try and cut through some of that noise around one particular giant, CTSH Cognizant. We've taken a pretty deep dive into their latest annual reports, their financial statements, and what analysts have been saying recently. Our aim is basically to give you a quick but well-informed perspective on their business model, their latest earnings results, and maybe what the future holds for them, especially
What
with AI being such a huge topic. Okay, let's unpack this.
Absolutely. And what's really fascinating here, I think, is watching how a company of Cognizant's sheer scale manages to navigate such a dynamic tech landscape. It's quite the balancing act. They're juggling these, established service offerings with some pretty aggressive investment in emerging transformative areas like artificial intelligence. We'll explore how these strategic choices aren't just, buzzwords on a slide deck. They're actually reflected directly in their operational decisions and, crucially, in their financial performance.
Okay, so before we really jump into the numbers and those future bets, let's just lay down the basics. For anyone maybe less familiar, what exactly is Cognizant? What do they fundamentally do for their clients?
Right. So, at its core, Cognizant is one of the world's leading professional services companies. Their whole mission, as they put it, is to engineer modern businesses.
Mm.
Now, what that means in practice is they help clients modernize their technology foundations, reimagine their core business processes, and really transform the experiences for their customers and employees. Think of them as a kind of guiding hand for big companies that need to stay competitive and, well, relevant in today's incredibly fast-moving world. Especially, as you said, with AI starting to reshape pretty much every industry, from healthcare to banking. They're not just consultants dropping off reports, they're deeply involved in the actual implementation, the doing.
That sounds incredibly broad, though. How do they actually deliver on such a wide range of services across so many different industries? Is it all like run from one central place?
Oh, not at all. No. They operate what they call an integrated global delivery model.
Mm.
So this means they have teams working directly at client sites, collaborating closely day to day. But they also have this vast network of dedicated global and regional delivery centers. I think they're spread across nearly 50 countries now.
50 countries. Wow.
Yeah, and their largest footprint, interestingly, is in India. Represents about 90% of their total delivery center square footage, actually.
90%. Okay.
Right, and this global setup lets them tap into diverse talent pools, operate around the clock if projects need it, and optimize for cost efficiency naturally, their services. It's a huge list. Everything from digital solutions and high-level strategic consulting, right down to hands-on application development, systems integration, quality engineering, even R&D support, plus ongoing application maintenance, infrastructure management, cybersecurity, and even business process services and automation. It's really a comprehensive suite designed to cover almost every tech and operational need an enterprise might have.
Okay, so a truly massive global operation. Now, this is where it gets particularly interesting for a lot of us tracking the tech space. They've been talking a lot about AI. How is AI specifically integrated into this, well, sprawling business model? Is it just another tool in the toolbox, or is it something more foundational?
Oh, it's definitely more foundational now. Cognizant views AI not just as some kind of add-on, but really as central to their future strategy. In 2024, they were very explicit about it, saying they doubled down on AI-led solutions. And this wasn't just talk. It translated into launching and significantly enhancing platforms. Things like Neuro AI, which is sort of their flagship for driving enterprise-wide AI adoption. Then there's Cognizant Flow Source, which is designed to automate complex workflows and boost efficiency. And Cognizant Moment, focusing more on generating real-time customer engagement insights. These aren't just, clever names. They're actual proprietary tools built to redefine how their clients operate in terms of efficiency, security, and customer experience.
So more than just consulting on AI, they're building platforms.
Exactly. And they talk about seeing AI-enabled opportunities in three key vectors, as they call them. First is hyperproductivity. That's basically using AI to streamline and speed up existing operations, making things vastly more efficient. Second, industrializing AI. That means moving beyond just like one-off AI pilot projects to creating repeatable, scalable AI solutions that can be applied across different clients and industries. Basically, making AI a core foundational layer for business processes. And third is agentification. Put simply, that's about creating more autonomous, goal-oriented AI systems that can almost operate independently within a client's business, freeing up human teams for higher value, more creative stuff. What's really insightful here, I think, is how they're not just selling AI as some cool new tech. They're fundamentally trying to re-engineer how their clients operate, aiming for both cost savings and deeper business insights.
That's a really helpful breakdown of how they see AI fitting in. So how is such a huge, multifaceted company actually structured internally to serve all these diverse, evolving client needs, especially with this heavy AI focus now?
All right, good question. Starting in 2025, they've actually reorganized themselves into four main reportable business segments. These are health sciences, financial services, products and resources, and communications, media, and technology. Each of these segments is basically set up to deliver highly specialized tech solutions, tailored specifically to the unique demands and regulations of those industries. Makes sense, right?
Yeah, specialization makes sense.
Yeah. And beyond those segments, they also have these dedicated key practices, like intuitive operations and automation, which, as the name suggests, focuses heavily on AI-led automation and business process outsourcing. And another one called software and platform engineering. They manage the core platforms for enterprise transformation and are pretty instrumental in accelerating the wider use of things like generative AI within their client base. Oh, and crucially, to make sure they're always offering cutting-edge stuff, they form these deep strategic alliances with the major cloud, and tech providers think Microsoft, Google Cloud, AWS. They bring those advanced capabilities directly into Cognizant's client solutions. So it's about being both broad in reach but also deeply specialized where it counts.
Okay, makes sense. Now let's shift gears a bit and look at the numbers. What do their latest earnings results tell us about Cognizant's financial performance in 2024, especially given, the challenging global economy we saw?
Okay, the numbers. Cognizant reported a total revenue of $19.7 billion in 2024. That marks a 2.0% increase from their 2023 figures.
Just 2% growth.
Well, yes, 2% growth. But their net income for 2024 was $2.24 billion.
Mhm.
What really stands out here, and it's quite significant, is that despite that macroeconomic environment being tough for many clients, often tightening their IT budgets, Cognizant still managed to grow revenue. And perhaps even more impressively, they actually enhanced their operating margin. That's a key indicator of a company's core business profitability.
Yeah.
That signals pretty effective cost management and a resilient underlying business, even if top-line growth was modest.
Okay, an enhanced operating margin is definitely good news. Can you break down what specifically helped them achieve that improvement? Were there specific drivers?
Certainly. So their GAAP operating margin, that's the profit from core operations before taxes and interest, it increased to 14.7% in 2024, up from 13.9% in 2023. Their adjusted operating margin, which kind of smooths out certain one-off items, also showed an increase, up to 15.3% from 15.1%. Now, a significant positive impact came from net savings they got from their next-gen program. This is essentially a multi-year internal efficiency drive focused on optimizing how they deliver services and where they operate from, streamlining things.
Ah, okay. Internal cost savings.
Exactly. Plus, they also benefited from favorable foreign currency exchange rate movements, particularly the depreciation of the Indian rupee against the US dollar. Since, as we said, a huge chunk of their delivery operations are in India, a weaker rupee effectively lowers their operational costs when you translate those back into US dollars. That positively impacted their operating margin by 44 basis points, nearly 0.5%.
Interesting. Any downsides pulling the margin back?
Yeah, there were some headwinds too. They saw negative impacts from increased compensation costs, partly due to a standard merit increase cycle in the third quarter, and also the dilutive effect of recent acquisitions. Acquisitions often bring transaction costs, integration expenses, and then the amortization of acquired intangible assets, which can temporarily drag down margins.
Right, integration isn't free. And drilling down a bit more, how did their different business segments and geographic markets perform within 2024? Was that 2% growth spread evenly?
Not entirely evenly, no, which is pretty typical for a company this diverse. Looking at revenues by segment, health sciences actually saw a solid growth of 4.5%. That points to continued strong demand in healthcare and life sciences. Products and resources also grew nicely by 3.3%, suggesting strength with their manufacturing, retail, and logistics clients. Communications, media, and technology had more modest growth, just 0.8%. Financial services, however, which is a really substantial part of their business, actually saw a slight decrease of 1.0%.
Oh, financial services down. Any idea why?
Well, that segment has definitely faced some macroeconomic headwinds. Banks and financial institutions were often quite cautious with their spending in that period. So a slight dip there isn't entirely surprising.
Okay. And geographically, how did North America do?
Geographically, North America, which is by far their largest market, showed a pretty healthy 3.0% increase in revenue. That's crucial for their overall performance, obviously. In contrast, the United Kingdom actually saw a decrease of 3.1%, while continental Europe had just modest growth of 1.2%. So it shows a varied picture, right? Strong in their biggest market, but facing some regional challenges elsewhere.
Got it. Beyond just revenue and margins, what about their cash flow situation and how are they, actively returning value to shareholders, dividends, buybacks?
Right, so cash provided by operating activities actually decreased in 2024, but this was primarily due to a significant one-off event, a $360 million payment related to a long-standing tax dispute they had in India.
Ah, that would definitely impact cash flow.
Exactly. It was a big payout that clearly hit their operating cash flow for the year. But despite that, they still maintain a healthy overall financial position. They ended 2024 with around 336,800 associates globally. Just shows the massive scale again.
That's a huge workforce.
It really is. Now, in terms of shareholder returns, they paid consistent quarterly cash dividends of 0.30 cents per share in 2024. That totaled $1.20 for the full year. And they've already approved a slight increase up to $1.31 per share starting February 2025. So that shows a clear commitment to consistent and slightly growing shareholder returns via dividends.
And buybacks?
Yep, they also have an active stock repurchase program. As of the end of 2024, they had about $1.237 billion remaining authorized under that program. Their stated capital allocation framework is pretty clear. They anticipate deploying roughly 50% of their free cash flow for strategic acquisitions and the other 50% for share repurchases and dividends.
50-50 split. Interesting.
Yeah, it signals a balanced approach, doesn't it? They're keen on growing through strategic M&A, buying new capabilities or market access, while also consistently rewarding their existing shareholders.
Okay, so we've covered where they've been, their structure, their recent performance. What does all this data suggest about Cognizant's future? Where are they heading now, and what are the analysts projecting, say, out to 2028?
Well, Cognizant themselves say they entered 2025 with momentum and confidence. Their reports lay out a pretty clear strategy focused on accelerating growth, amplifying their talent pool, especially in key areas like AI and scaling innovation. Analysts watching the company closely are projecting they could reach somewhere around $23.4 billion in revenue and maybe $3.0 billion in earnings by 2028.
$23.4 billion. What kind of growth rate is that?
That assumes a compound annual revenue growth rate of about 4.6% from their 2024 base.
Okay, 4.6% annually.
Yeah. And this outlook isn't just, plucking numbers from the air. It seems supported by their very explicit focus on strengthening their core capabilities while also expanding leadership in key industries, particularly around these AI-driven solutions we've been talking about.
That's a significant growth projection, getting back towards mid-single digits. What are the major opportunities you see that could actually drive this, especially with that big AI push? And how do they plan to stand out in what's becoming a very, very crowded AI services market?
Well, their Q1 2025 commentary, the most recent we have, really highlighted a significant shift in the market towards cost takeout and productivity-led deals. And critically, they see this as being largely driven by AI. In fact, they made a pretty bold statement on your earnings call. It's something like, AI productivity, we are the only one calling it out and bold enough to tell our clients this is productivity we can benefit from with our client work, something very close to that.
Wow, that is bold. Basically saying they can deliver measurable AI benefits others can't.
That's the implication, yeah. It suggests a really strong competitive stance. They seem to believe they're uniquely positioned to drive demonstrable, quantifiable efficiency gains for their clients using AI, rather than just talking about abstract AI innovation or potential futures. It's about results now.
And how else are they driving that?
Well, they're also focusing intensely on their own internal efficiency, which ties back to margin expansion. For example, they mentioned aiming to improve utilization. That's the percentage of time their billable staff are actually working on client projects, aiming for 85%, up from 82% last year. They're also pursuing what they call pyramid correction. That basically means strategically hiring more junior talent, likely at lower cost, and then using AI tools internally to elevate their productivity quickly, allowing them to handle more complex tasks sooner and reducing the overall cost of delivery.
So using AI internally to boost margins too.
Precisely. It's all deeply intertwined with leveraging AI productivity gains, both for clients and for themselves, ultimately driving margin expansion. Plus, they continue to pursue strategic acquisitions, like Belkin, which they acquired in 2024. That move significantly enhanced their offerings and talent pool, particularly in key AI and digital areas like engineering research and development, or ER&D. That expands their capabilities into some pretty lucrative high-growth sectors.
Okay, that makes sense. betting heavily on AI productivity, both externally and internally. But this raises the obvious question. What are the biggest hurdles or risks they face in actually executing this ambitious strategy and hitting those projections? It can't all be smooth sailing.
No, definitely not. There are several pretty significant hurdles for sure. First, just the broader macroeconomic and geopolitical conditions. Any downturn or instability in key markets, the US, Europe, or even India, where so much of their workforce could cause clients to pull back on IT spending fast. That's always a risk.
Standard cyclical risk.
Right. Second, competition is just incredibly intense. You've got the huge global players like Accenture, Infosys, TCS, Capgemini. Then you have smaller, highly specialized local firms nipping at their heels. And increasingly, you even see clients trying to develop more of their own tech resources in-house. It's a tough market,
Constant pressure.
a constant pressure. Third, rapid technological change, especially in AI, is definitely a double-edged sword. It's their biggest opportunity, no doubt. But if they fail to develop and implement the right cutting-edge AI solutions effectively, or maybe just not fast enough compared to competitors, their financial performance and even their reputation could be badly impacted. They have to keep running just to stay in place, essentially.
The innovation treadmill.
Exactly. Talent retention is another massive challenge, particularly in the tech sector. Their voluntary attrition for tech services staff was 15.9% in 2024, which was actually up from 13.8% in 2023. Attracting and, crucially, keeping top AI talent is absolutely critical, and it's expensive.
Yeah, retaining talent is key.
Absolutely.
Yeah.
And lastly, they operate globally, remember. So they have to navigate this incredibly complex web of legal and regulatory requirements across dozens of jurisdictions. Everything from data security and privacy laws, which are getting stricter everywhere, to complex international tax laws. That just adds another layer of operational risk and cost.
Okay, so definitely not without its challenges. So there you have it, a pretty comprehensive picture of CTSH Cognizant, wouldn't you say? We've seen a company that's really doubling down on AI, managing its finances quite strategically for both growth and shareholder returns, all while navigating this complex, very competitive global landscape. Their big bets on AI-driven productivity seem to be really influencing not just their client conversations, but their own internal operations and cost structure. It signals a very focused path forward.
Indeed. I think their latest results really show a company actively adapting to a rapidly changing market. They're focusing on their core strengths while investing heavily and strategically in the future of technology services. That emphasis on AI-led transformations, the internal efficiency drive, the strategic acquisitions, it all signals a clear direction. But as we discussed, it's a path that definitely comes with its own significant set of competitive and operational considerations in this incredibly fast-moving tech world.
Absolutely. And that leads us, as always, to our provocative thought for you, the listener, to mull over. As companies like Cognizant increasingly embed AI, not just into the services they sell to clients, but deep into the very fabric of their own operations, that internal efficiency, their talent strategies, how they manage that pyramid structure, how might this fundamentally reshape the entire professional services industry over, say, the next decade? Will AI-driven efficiency become the sort of primary, maybe even the sole differentiator between firms? Or perhaps counterintuitively, will the human element, things like creativity, nuance, relationship building, complex, ambiguous problem solving, actually become even more valuable, maybe even scarcer in this increasingly hyper-automated future? Something to think about.